Imagine trying to drive a car with both the gas pedal and the brake pressed down hard simultaneously. That's pretty much the picture for the U.S. economy in 2025. You see, on one side, we've got this massive One Big Beautiful Bill Act, the OBBBA. It's pumping up the economy with big tax cuts, lots of spending. But then, fighting directly against that, you have these really aggressive tariffs. And they're acting like a widespread tax on almost everything. This policy tug-of-war is creating a truly unique, kind of precarious situation. And it's why, when we look through this stack of comprehensive analyses for today's deep dive, one finding really jumped out: a significant 45% probability of a stagflation scenario. Now, for those of you maybe new to the term, stagflation is, frankly, the worst of both worlds. It's where you see prices rising and economic growth slowing down at the same time. So today, we're diving deep into the U.S. economic policy portfolio for 2025. Our mission here is to distill the most important insights, really pinpoint the critical risks, and show you exactly what you need to be watching as these two powerful opposing forces collide.
Okay, so let's unpack this central policy contradiction first. On one side, this hugely expansionary fiscal agenda, right, spearheaded by the OBBBA. What are its main parts, and what's the real impact we're seeing?
Well, the critical thing to grasp here, I think, is just the sheer scale and the long-term commitment involved. The OBBA, it was signed into law July 4th, 2025. Made most of the 2017 tax cuts permanent.
For individuals and corporations.
Both, yes. And it introduced new tax exemptions, significantly boosted discretionary spending, think in defense, border security. Now, the stated goal is, robust growth, but the fiscal impact, it's staggering. The CBO, the Congressional Budget Office, they estimate it'll add at least $3.4 trillion to the deficit over the next decade.
$3.4 trillion.
At least. Some estimates, if you factor in the interest costs, go even higher, maybe over $4 trillion. So this creates a fundamental shift, really, in the nation's long-term fiscal health. And it could significantly tie the Federal Reserve's hands down the road.
Okay, so a massive fiscal injection designed to boost the economy. But here's where it gets, as you said, really interesting. How is this expansionary push fighting against the administration's trade policy? Because, they sound like completely opposite directives.
It's a direct conflict, almost unprecedented, really. So back on April 2nd, 2025, the administration invoked IEEPA, that's the International Emergency Economic Powers Act,
Right.
declared a national emergency, basically, to impose what they're calling reciprocal tariffs.
Yeah.
Initially, these things just shot up. They raised the average applied U.S. tariff rate from 2.5%.
Tiny?
Yeah, tiny, to an estimated 27%. Big jump. Now, there was a bit of a stock market dip, so they paused them temporarily, but a revised schedule is set to take effect very soon, August 7, 2025.
Okay, that's critical.
Very critical. Rates there will range from 11% up to a staggering 50% for about 80 countries. The current average effective rate, even before that, it's already 18.3%. That's the highest it's been since 1934.
Wow, since the Great Depression era.
Exactly. And beyond those broad strokes, they hit specific sectors really hard. I think 50% on steel, aluminum, copper, another 25% on autos and auto parts. But maybe the key takeaway for you as a listener isn't just that there are tariffs, it's the unpredictability of how they're imposed. Well, this approach largely bypasses Congress, right? It centralizes the tariff-setting power within the executive branch. So when policy can just pivot overnight, basically by executive order, it fundamentally breaks traditional risk models for businesses. It chills investment. It complicates any long-term supply chain planning. And that's exactly why we're seeing the Economic Policy Uncertainty Index spiking.
Makes sense.
Yeah, it's like businesses are trying to plan in a hall of mirrors. I heard one CEO joke their 5-year plan now changes every Tuesday.
Okay, so if we're pouring gas with the OBBBA, but slamming the brakes with tariffs, what does this actually mean for aggregate demand and supply, the overall economy? Are we just canceling ourselves out, or is one side winning?
Well, you're right to ask that, and the analyses suggest it's actually a net negative overall. If you look at it from a demand perspective, what economists call the Keynesian view, the OBBBA, is like direct fuel.
Right.
Trying to put more money in people's pockets, encourage investment, standard stimulus.
Right.
But the tariffs, they act like a huge tax, basically, on consumers and businesses. The Yale Budget Lab actually put a number on it. They estimate it's like an income loss of about $2,400 per household.
Ouch.
Yeah, directly cuts purchasing power. And of course, tariffs hit exports too because other countries retaliate. Goldman Sachs ran some models suggesting these tariffs could subtract maybe 0.8 percentage points from GDP growth. while the OBBBA boost is only adding maybe 0.1 to 0.2 points.
So a net drag on demand.
Almost certainly, yes. The net impulse looks negative. And then on the supply side, the picture is also pretty concerning. Now, sure, you've got deregulation in energy and finance, plus OBBBA made full expensing for R&D and capital permanent. Those things are intended to boost productive capacity. But the tariffs on intermediate goods, things like steel, copper, they directly raise production costs for U.S. manufacturers right now. This forces costly, disruptive supply chain changes. It makes the economy less efficient, basically. And layered on top of that, more restrictive immigration policies can create labor supply shocks, especially in sectors that rely heavily on immigrant labor. You get shortages, increased costs.
So it sounds like we're almost intentionally creating our own supply shocks here.
Yeah.
That kind of economic self-sabotage,
Yeah.
it's not entirely new territory, is it? To really get a handle on the stakes here, maybe we should look back. Consult history. What can past policy collisions tell us about the risks we're facing now? How are things similar and maybe crucially different?
Absolutely. Looking to history is key here. For the aggressive broad tariffs, the closest parallel is probably the 1930s, specifically the Smoot-Hawley Act of 1930.
Right, infamous.
Infamous is right. That act jacked up average import duties by about 20%. It led to just a catastrophic collapse in global trade. U.S. exports fell over 60%. It's widely seen as deepening the Great Depression.
But what's the key difference now?
The crucial difference. Back then, we had fiscal austerity. Governments were tightening their belts. Now, we have highly expansionary fiscal policy with OBBBA. That's a huge contrast. But the lesson remains. Trade protectionism can spiral really fast and really badly.
Okay, so that's the trade parallel. What about other eras?
Well, then you look at the 1970s stagflation. That gives us the closest analog for the type of challenge we face. The 70s were defined by negative supply shocks, mostly the OPEC oil embargoes. Those shocks pushed inflation up and dragged growth down simultaneously.
Stagflation definition.
Exactly. And in 2025, this tariff regime, it functions very similarly. It's like a domestically engineered supply shock. It pushes inflation up by raising costs. It drags growth down by hitting real incomes and exports. And this puts the Federal Reserve in an almost impossible bind. It's like asking a firefighter to put out a blaze while someone else keeps pouring gasoline on it.
That's a powerful analogy. Okay, what about the 80s?
Right, the early 1980s. The Volcker Shock and Reaganomics. That's another distinct parallel. You had extremely tight monetary policy, Volcker jacking up rates, colliding head-on with loose fiscal policy, the Reagan tax cuts, defense spending buildup.
Policy collision again.
Exactly. And it caused a deep recession, 81, 82. But importantly, once inflation was broken, a strong recovery followed. But here's the key difference for 2025, and it's critical. The 1980s policy mix was fundamentally disinflationary. The explicit goal was to crush inflation. Our current mix, with tariffs and huge deficits, it's inherently inflationary. That makes the Fed's job vastly more complex, especially, with government debt already sky high. We're around 121% of GDP now, way higher than in the 70s or 80s.
Okay, that really highlights the Fed's dilemma. So that leads to the obvious question, what is the Federal Reserve stance amidst all this? Are they giving in to any political pressure for rate cuts? Or are they holding the line against these inflationary pressures you described?
Well, so far they've resisted that pressure, publicly at least. The FOMC, the Federal Open Market Committee, they held rates steady at their last meeting, July 30th. Their statement specifically mentioned somewhat elevated inflation and elevated uncertainty about the outlook.
So they see it.
They definitely see it. The Fed's own analysis acknowledges these higher tariffs are pushing up prices for consumers. However, and this is a big however, financial markets, they're still pricing in a pretty high chance of 2, maybe 3 rate cuts by the end of the year.
Why the disconnect? Are they just betting on a slowdown?
That seems to be the bet, that a growth slowdown will eventually force the Fed's hand, regardless of inflation. But this creates a significant risk, right? A risk to the Fed's credibility. If they cut rates prematurely while inflation is still high or rising because of tariffs, they risk losing that hard-won reputation as inflation fighters. You could end up back in a 1970s-style wage price spiral if people lose faith in the Fed's resolve.
That's a really chilling thought. Okay, so given all these conflicting signals, these historical echoes, the Fed's tough spot, let's talk about the possible paths forward. The analysis we reviewed lays out 4 key scenarios for the U.S. economy, each with a different probability, painting a pretty clear picture of the risks ahead. Can you walk us through those?
Sure. Yeah, we've got a range of possibilities from, cautiously optimistic to quite severe. First scenario, soft landing. This has about a 20% probability assigned. This is the optimistic take. Tariffs get rolled back somehow, maybe new trade deals emerge. OBBBA provides a well-timed temporary boost. Maybe productivity gains from AI or deregulation offset some inflation. In this world, growth is okay, maybe around 2.0%, and inflation settles near 2.5%.
The ideal outcome.
So the ideal, yes, but only 20% likely according to this analysis. Then, our base case, the most probable scenario is stagflation. This gets a 45% probability.
Nearly half.
Nearly half. Here, the tariffs stay in place. They act as this persistent negative supply shock we've been talking about. You'd likely see core inflation peaking around 3.5%, while real GDP growth really slows down, maybe to just 1.0% by the end of 2025. In that scenario, the Fed is forced to keep policy tight, keep rates high, which likely tips the economy into a mild recession, probably starting in 2026. Unemployment would tick up maybe to 4.5% by year-end 2025.
Not great. What else?
Third scenario, deflationary recession. This is more of a stress case, assigned a 25% probability. This involves a full-blown global trade war erupting, a sharp contraction in global trade, global manufacturing. This kind of severe global demand shock would just overwhelm any domestic stimulus from OBBBA. You could see U.S. real GDP actually contracting by 1% or 2%. Unemployment would likely jump above 6%.
Pretty nasty. And the last one?
The last one is the tail risk, financial crisis. Lower probability, around 10%. But this could be triggered by a sudden, severe policy shock. Maybe a sharp, unexpected escalation in tariffs. Combined with existing vulnerabilities like high leverage in some opaque corners of the market. Think about the private credit market. It's estimated at $1.5 trillion now.
Right. We hear more about that.
Exactly. A shock could trigger a liquidity crisis in areas like that, leading to a really severe, deep recession.
Okay, those scenarios really lay out the stakes. What strikes me, though, is how, well, maybe complacent financial markets seem despite these risks you just outlined. What are the warning signs you think people should be looking for? Because it feels like the markets might be ignoring some pretty big red flags right now.
You're absolutely right. There seems to be a clear disconnect. Look at equity markets, for instance. Valuations are flashing some serious warning signs. Indicators like the CPE ratio, the Buffett indicator, they're at levels historically only seen right before major crashes like 1929 or 2000. Hints of extreme overvaluation. And market leadership.
Yeah.
It's incredibly concentrated. Those magnificent 7 tech stocks make up roughly a third of the S&P 500's value. That's even more concentrated than during the dot-com bubble.
Which didn't end well.
Didn't end well at all. And yet, volatility, the VIX index, remains stubbornly low. That suggests investors are, well, complacent, not pricing in the risks.
What about bond markets? Are they telling you a different story?
They are sending clearer warning signals, actually. The Treasury yield curve, the difference between long-term and short-term interest rates has been inverted for a historically long time.
The classic recession indicator.
The classic indicator, yes. It's preceded almost every U.S. recession since the 1950s. And now it's starting to uninvert or steepen. That's often the final signal that a recession is imminent as markets start pricing in future Fed rate cuts because they expect a slowdown.
Okay, so bonds are nervous.
Parts of the bond market are, yes. But contradicting this, corporate credit spreads are still remarkably tight. That means investors aren't demanding much extra yield, much compensation for taking on the risk of lending to companies. That reflects optimism you don't see elsewhere.
Strange mix.
It is. And then you have underlying systemic risks. U.S. banks are sitting on about $500 billion in unrealized losses on their securities portfolios. And as we mentioned, that opaque private credit market is a growing concern. Lots of leverage, not much transparency.
Okay, so connecting this back to the real economy, how are these contradictory policies actually hitting specific sectors? And what about our global relationships? Is anyone actually winning in this environment?
It's tough to find clear winners. Every sector seems caught in this tug-of-war. Take manufacturing. They get promised protection from tariffs, right?
Yeah.
But then they face rising input costs from those exact same tariffs, like the 50% duties on steel. It's a double-edged sword. Agriculture is facing retaliatory tariffs on key exports. Soybeans, pork, plus higher input costs. Any government aid is likely just a temporary patch. Technology companies, they're accelerating costly efforts to diversify supply chains away from China. Plus, stricter immigration policies make it harder to attract top global talent.
What about energy or finance?
Well, the energy sector probably benefits somewhat from deregulation efforts, but consumer energy costs are projected to rise significantly in the long run. Some models show a really substantial increase by 2035.
So consumers pay more.
Ultimately, yes. And financial services benefit from some deregulation too, but they face huge macroeconomic risks if there's a slowdown. Think about commercial real estate stress. Over $1 trillion in mortgages are maturing soon. Rising loan delinquencies are also a worry.
And globally, how are relationships holding up?
They're strained. China's retaliatory tariffs hit 125% at their peak, their current truce with the U.S. It expires August 12, 2025. That's another huge date.
Another cliff edge.
Exactly. Canada, the EU, they've also got retaliatory duties in place. Alliances are strained. This whole fragmented environment is a significant headwind for the entire global economy, not just the U.S.
Okay, this is a lot to track.
Mm-hmm.
Given the high stakes, the uncertainty, what should you, our listeners, be watching most closely in the coming weeks and months? What are the absolute critical dates and indicators to keep an eye on to gauge where we're headed?
Okay, definitely several critical things to monitor. First, the decision points. Mark your calendars. August 7, 2025, that's the scheduled date for the new reciprocal tariff rates to kick in. Any delay, change, or confirmation there is critical.
Got it. August 7th.
Then, August 12, 2025, that's when the temporary U.S.-China tariff truce expires. If that's not extended, major escalation.
Okay.
Then September 17, 2025, that's the next FOMC meeting. The Fed statement, their economic projections that'll give crucial insight into how they see these conflicting signals playing out.
Fed meeting, Sep 17th. Anything else calendar-wise?
Later in Q4, keep an eye on the congressional debates around the fiscal year 2026 budget. That will signal the longer-term sustainability or lack thereof of this current fiscal policy path.
Right. And in terms of economic indicators,
Right.
what are the key ones?
Beyond those dates, watch these leading indicators closely. First, the Conference Board Leading Economic Index, LEI. It's already been flashing recession warnings for 3 months straight. Continued weakness, there would be a strong confirmation of a downturn.
LEI.
Second, keep watching those Treasury yield curve spreads, especially the 10-year minus 2-year and the 10-year minus 3-month. Further steepening there is often that final recession signal. Third, the Economic Policy Uncertainty EPU Index. If that spikes again, particularly the trade sub-index, it shows rising business anxiety. It was already high back in March.
EPU index.
Fourth, high-yield credit spreads, like the ICE BOFA index. If those widen sharply, say, above 400 or 500 basis points, that signals real credit stress. Right now they're tight, showing that disconnect we talked about. And maybe also the VIX, the volatility index. A sustained move above 30 would signal a real shift from just uncertainty to actual fear in the markets.
Okay, VIX above 30. That's a good list to track.
Yeah.
So wrapping this up, what's the big picture here? We've got this fascinating, honestly quite precarious situation. Powerful economic policies pulling in opposite directions. The core message seems to be that deliberate policy choices, not just abstract market forces, are creating very real, very tangible risks for the economy. This whole deep dive really underscores a critical point, doesn't it? The U.S. economy is truly at a crossroads, navigating a unique, high-stakes policy experiment. Will it somehow manage a soft landing? Or are we actually heading into a really challenging period, stagflation, a deeper recession, maybe even, God forbid, a financial crisis?
It really does feel like a crossroads. And perhaps this raises an important final question for you, the listener, to consider. How will the administration's apparent focus on, let's say, political priorities rather than maybe pure economic optimization? How will that ultimately shape the trajectory of these complex, contradictory policies in the long run? And maybe even more importantly, what kind of long-lasting impact will that have on the U.S.'s role as a global economic player? Something to really mull over.